What you are watching right now is not a market update. It is a countdown clock. And for the vast majority of people scrolling through financial headlines this Wednesday, April 29th, 2026, there's a profound, almost dangerous lack of awareness regarding what that clock is actually counting down toward. On the surface, the numbers look like a standard midweek correction. Silver is trading at a bid of 72.54. The ask is 72.79. It is down about 0.5% on the day, oscillating within a range that suggests a market in search of a direction. Gold sits at $4,562.90, mirroring that same quiet retreat. But these numbers are a masterclass in modern financial misdirection. In the world of high-stakes geopolitics and macroeconomics, there's a phenomenon known as the information lag, the gap between a structural shift in the physical world and the time it takes for that shift to be reflected in the digital, paper-based pricing systems of the West. Today, that gap has become a canyon. We are currently witnessing the single most consequential restructuring of global energy architecture in the last 60 years. We are watching the foundational pillars of the American monetary system being dismantled and redesigned in real time. And tonight, within a single 60-minute window, 4 companies worth a combined $11 trillion will report earnings that could either validate the AI-driven prosperity of the last decade or expose it as a hollow infrastructure bubble. At the center of this convergence sits a single misunderstood asset, silver. To understand why $72 silver is the most important number on your screen today, you have to look past the ticker and into the vaults. While the paper price reflects a narrative of calm, the physical market is screaming. For weeks, the delivery pressure on the COMEX has refused to ease. There is a widening structural detachment between the amount of silver being promised on paper and the physical metal actually sitting in certified vaults. This is not a technical glitch. It is a signal of a system reaching its physical limits. In a world of digital derivatives, we often forget that you cannot build a solar panel with a futures contract. You cannot stabilize a failing currency with a digital promise. You need the atoms, you need the metal. And right now, the atoms are moving east, while the paper is being shuffled in the west. But why now? Why does this Wednesday feel like the edge of a precipice? It is because the energy floor that has supported the global economy since the 1970s is quite literally washing away. For 17 days, the Strait of Hormuz, the most critical maritime choke point on the planet, has been functionally closed to normal tanker traffic. This isn't just another regional skirmish, it is a fundamental blockade of the world's jugular vein. Brent crude is sitting above $98 a barrel, not because of a temporary spike, but because the market is beginning to price in a world where the old rules of energy distribution no longer apply. In 48 hours, the United Arab Emirates will formally withdraw from OPEC. This is a 58-year-old marriage, ending in a public, messy divorce that signals the end of the cartel era. It is the second largest structural shock to energy architecture since the 1974 Petro-Dollar agreement. And yet, if you look at the silver price today, you see a minor dip. You see a reaction to a headline, a claim from the White House that Iran is on the verge of collapse, a claim offered without a name, a date, or shred of documentation. Trading algorithms, which are built to react to signals rather than interrogate sources, bought the narrative. They sold the metal to buy the dollar. This creates an extraordinary paradox. How can the world's most electrically conductive metal, the literal backbone of the renewable energy transition, be trading down on the same day that global energy security is fracturing? How can a metal that China is currently importing at triple its historical average be seen as a declining asset in New York? The answer lies in the difference between a market and a narrative. One is governed by the laws of physics and supply. The other is governed by the perception of stability. Tonight, that perception faces its ultimate test. As Jerome Powell prepares for what may be his final meaningful press conference, the shadow of a captured Federal Reserve looms over Washington. The independence of the world's most powerful central bank is being traded for political alignment, just as $11 trillion of equity value prepares to hit the scale. If the tech giants fail to justify their staggering AI expenditures, and if the Fed signals that its mandate is now subject to executive co-design, the paper fortress that has housed global capital for decades will begin to look remarkably fragile. The question we have to ask ourselves is simple. When the narrative finally collides with the physical reality, where does the capital go? Does it stay in a programmable digital system that is being redesigned by politicians? Or does it flee toward the assets that exist outside of that system? Assets that cannot be printed, programmed, or wished into existence. We are not just looking at a silver shortage. We are looking at the end of an era of institutional trust. The countdown has already begun. The strait is closed, the cartel is breaking, the Fed is shifting, and the physical metal is disappearing. By the time this week is over, the $72.54 you see on your screen will likely be a relic of a world that no longer exists. There's a lot to unpack, and every single piece of this puzzle connects back to the same fundamental truth. The window is open, but it is closing fast. Let's look at how we got here. To understand why the world is currently standing on the edge of a structural precipice, we have to look back to a room in 1974 and a deal that effectively designed the modern world. In the wake of the 1973 oil crisis, Henry Kissinger sat down with the House of Saud to broker what we now know as the Petro-Dollar agreement. The terms were simple but world-altering. Saudi Arabia would price its oil exclusively in US dollars and invest its surplus reserves into US treasuries. In exchange, the United States provided a security guarantee that made the Saudi kingdom the most protected energy hub on earth. This was the birth of a grand global synthesis. It turned the US dollar from a currency backed by gold into a currency backed by the very substance that powers industrial civilization. For 50 years, this arrangement forced every nation on the planet to accumulate dollars if they wanted to keep their lights on. It created a permanent artificial demand for the greenback, allowing Washington to run massive deficits while the rest of the world subsidized American debt. It was the exorbitant privilege in its purest form. But this system relied on a specific kind of stability. It required a coordinated energy market, a cartel that could manage supply and demand with enough predictability to keep the dollar-denominated world spinning. That coordination was the job of OPEC. For 6 decades, OPEC functioned as the world's central bank of energy. Even when member states were at each other's throats, the cartel provided a unified framework that gave the world, and the dollar, a floor. What we are witnessing today, as the United Arab Emirates prepares to walk out of that door on May 1st, is the final expiration of that 50-year synthesis. The UAE isn't just a minor player, it is the 3rd largest producer in the world. When a founding pillar that has been a member for 58 years decides to quit, it isn't a policy shift, it's a regime change for the global economy. The seeds of this divorce were sown back in November 2024, during a loud public dispute over production quotas in Riyadh. At the time, the UAE wanted the flexibility to increase its capacity to 5 million barrels per day by 2027. They wanted to monetize their resources on their own timeline, while Saudi Arabia insisted on the collective discipline required to keep prices elevated. It was the classic tension of a cartel, the individual's need for growth versus the collective's need for control. However, the why behind this exit goes far deeper than a disagreement over barrels. It is a story of sovereign survival under live fire. Since April 13th, the Strait of Hormuz, the narrow waterway that carries 95% of Abu Dhabi's state revenues, has been a contested military zone. For 17 days, Iranian drones and rocket systems have targeted UAE infrastructure, effectively holding the nation's economy hostage. In this context, the UAE's loyalty to OPEC became a strategic liability. Historically, OPEC has often accommodated Iranian interests when it was geopolitically convenient for the larger bloc. Abu Dhabi has looked at the landscape and reached a chilling conclusion. They are under direct military pressure, their primary economic artery is being squeezed by an adversary, and the cartel they've supported for half a century can no longer guarantee their security or their income. By exiting OPEC, the UAE is effectively choosing a new side. They are repositioning themselves as America's primary dedicated refueling station in the Persian Gulf. They are trading the collective leverage of a cartel for the bilateral protection of a superpower. For Washington, this is a masterstroke decades in the making. The fragmentation of OPEC has been a quiet goal of American foreign policy for a generation. By splitting the UAE from the Saudi-led bloc, Washington has achieved the divide and conquer of global energy. What remains is a Riyadh-centered remnant, a diminished OPEC-, with significantly less power to resist American demands on production or pricing. But here is the analytical irony that the markets are missing. While Washington has succeeded in breaking the cartel, it has simultaneously accelerated the erosion of the dollar's structural integrity. The petrodollar system worked because the world was stable and energy was coordinated. When you replace that coordinated framework with a fractured, mercenary energy market where sea lanes are contested and production is used as a military lever, the dollar loses its status as a reliable proxy for energy security. When $98 oil is driven by drone strikes rather than supply-demand equilibrium, the world starts looking for a way out of the dollar-denominated chaos. This is where the historical parallel becomes striking. In 1974, the dollar moved from gold to oil. In 2026, as the oil-based architecture cracks, the world is moving back toward the only thing that cannot be blockaded in a strait or devalued by a central bank: hard assets. The historical Big Bang of the dollar is being followed by a big crunch. We are moving from a world of institutional trust, where we trusted OPEC to manage oil and the Fed to manage money, to a world of physical verification. This is why the COMEX delivery pressure on silver is so vital. It is the first symptom of a global capital reallocation. Capital that has been parked in dollar-denominated systems for 50 years is starting to realize that the security guarantee of 1974 no longer applies. The UAE is walking because it has to. The strait is closed because the old order is dead. And silver is being accumulated because when the architecture of the last 60 years finally collapses, you don't want to be holding a paper promise. You want to be holding the metal that powers the next century's energy before the rest of the world realizes the floor has been pulled out from under them. The mechanics of this shift are not just geopolitical, they are technical, data-driven, and happening inside the very vaults that are supposed to keep the system running. And to understand the true depth of the shortage, we have to look at the engine room of the silver market itself. To understand why the price on your screen is lying to you, we have to look into the engine room of the global silver market. In a rational world, the price of a commodity is the point where supply and demand meet. But in the modern financial world, we don't trade the metal. We trade a digital ghost of the metal. This is the world of the COMEX, the primary futures exchange where the paper price of silver is manufactured. The mechanics of this system are built on a foundation of fractional reserves. For every 1 ounce of physical silver sitting in a certified COMEX vault, there are hundreds of ounces of paper silver circulating in the form of futures contracts, options, and derivatives. This works perfectly well during times of abundance. It's like a game of musical chairs where 500 people are dancing around a single chair. But as long as the music never stops, everyone is happy to hold their ticket. The delivery pressure we are seeing today is the sound of the music slowing down. When traders speak of delivery pressure, they are describing a widening gap between open interest, the total number of contracts demanding physical delivery, and the actual registered inventory available to satisfy those demands. As of this Wednesday morning, that pressure has reached a terminal velocity. Despite the $72.54 price tag, physical metal is not moving into the vaults to cover these obligations. It is moving out. The paper mirage is beginning to evaporate because, for the first time in a generation, the holders of these paper tickets are actually asking for their chairs. While the West remains fixated on the paper ticker, a massive structural arbitrage is draining the system from the East. The data for March 2026 is staggering. China imported approximately 836 metric tons of silver in a single 30-day window. To put that in perspective, the 10-year average for March is roughly 306 metric tons. We are seeing nearly triple the normal volume of metal flowing into a single nation. This isn't just a government-level strategic stockpile, it is a multi-layered vacuum. On one level, you have the Chinese retail investor. Having watched the property market falter and the digital currency experiments evolve, they are moving into small format silver bars with both hands. On another level, you have the Shanghai Gold Exchange, trading at a significant premium over London and New York. This creates a gravity well. Traders buy silver at the lower paper price in the West, take physical delivery and ship it to Hong Kong or Shanghai to capture the higher price. This arbitrage doesn't just lower Western inventories, it hollows them out. But the most critical mechanical driver is one dictated by the laws of physics, not finance. Silver is the most electrically conductive metal on Earth. It has the lowest contact resistance of any element. In the world of 2026, where the Strait of Hormuz is a war zone and Brent crude is hovering near $100, silver has transitioned from a decorative luxury to a frontline strategic necessity. Every solar panel, every photovoltaic cell being installed from the deserts of Nevada to the rooftops of Beijing requires silver paste. This paste is the nervous system of the panel, responsible for collecting the electrons generated by the sun and moving them into the grid. While the industry has spent a decade trying to thrash or reduce the amount of silver used per panel, the sheer volume of global solar installations has outpaced those technological gains. We are now in a conductivity bottleneck. As energy prices spike, the demand for solar capacity expansion becomes an existential mandate for industrial nations. This creates a feedback loop. The higher the price of oil, the more urgent the transition to solar. The more urgent the transition to solar, the more silver is consumed. The more silver is consumed, the more the physical supply vanishes from the vaults. This is the why behind the massive Chinese stockpiling. Chinese manufacturers, who dominate the global photovoltaic supply chain, are not waiting for the paper price to catch up to reality. They are front-running the shortage. They are securing the atoms today because they know that tomorrow the paper price won't matter if the physical metal isn't there to fulfill the order. What we are witnessing is the great decoupling. On one side, you have the Western financial algorithms reacting to headlines and Fed press conferences, keeping the paper price suppressed. On the other side, you have the physical reality of 836 tons of metal crossing the border into China, the functional closure of the world's most important oil transit point, and an industrial sector that cannot function without a metal that is currently in a state of terminal scarcity. The mechanics are broken. The dashboard says 72.54, but the engine is seizing. In any physical system, when the pressure reaches a certain point and there is no relief valve, the system fails. In the silver market, that failure doesn't look like a slow decline. It looks like a vertical repricing. The divergence between the digital narrative and the physical inventory has reached a historical extreme. And as we move into the global consequences of this shift, we see that the winners and losers of this decade will not be determined by who has the most paper, but by who has the most metal. The shockwaves of a structural realignment do not travel in a straight line. They move like a tsunami, silent in the deep water, only becoming visible as they reach the shore. As we stand here on April 29th, the ripples from the Persian Gulf and the COMEX vaults are colliding with the very heart of Western financial power, Washington, D.C. and the Silicon Valley tech giants. The result is a geopolitical perfect storm that is systematically dismantling the status quo. The first and most immediate consequence is the death of an illusion, the independence of the Federal Reserve. For decades, the Fed's perceived autonomy was the shield of credibility that protected the dollar's value. But today, that shield has been lowered. The sequence of events is chillingly precise. A Department of Justice investigation into Jerome Powell dropped the moment a replacement, Kevin Warsh, was signaled, followed by the Senate Banking Committee's vote today to install a chair who has historically aligned with executive political priorities. When the President of the United States explicitly states an intent to co-design interest rate policy, the central bank ceases to be a referee and becomes a player on the team. The analytical why here is profound. An independent Fed functions as a brake on the engine of money creation. A captured Fed is an accelerator. When monetary discipline is traded for political expediency, currency debasement is no longer a risk, it is a policy. For silver, this is the ultimate catalyst. Silver isn't just an industrial metal, it is a 5,000-year-old insurance policy against the hubris of kings and committees. When the world watches the world's reserve currency lose its institutional anchor, the flight to reality begins. While Washington shifts its leadership, the economic engine of Europe, Germany, is showing signs of catastrophic fatigue. The IFO Business Climate Index has collapsed to 84.4, a level of pessimism not seen since the height of the 2020 lockdowns. But this isn't a pandemic, it is a resource heart attack. When the world's fourth largest economy sees its military, the Bundeswehr, fail to procure diesel tank containers because the price has exceeded the state's procurement authorization limits, you're no longer looking at inflation. You are looking at the breakdown of state capacity. If the most disciplined industrial power in Europe cannot afford to fuel its own defense, what does that say about the viability of the broader Eurozone? This stagnation in the West provides a stark contrast to the aggressive accumulation in the East. We are seeing a global transfer of wealth that is both physical and permanent. China's triple average silver imports are not merely a trade statistic, they are a geopolitical fortress-building exercise. By hollowing out Western inventories, the East is positioning itself as the landlord of the new energy economy, while the West remains trapped in a stagflationary cycle of low growth, 1.2% in the US, and accelerating costs. But perhaps the most volatile ripple is the one currently moving through the $11 trillion big tech stack. Tonight, Microsoft, Amazon, Alphabet, and Meta will report earnings that represent nearly 40% of the S&P 500's momentum. For 3 years, the global economy has been fueled by a single narrative, the AI infrastructure boom, but that narrative is showing its first structural fractures. The cancellation of the OpenAI Oracle data center in Texas due to financing issues is the canary in the coal mine. Microsoft has committed over $100 billion to infrastructure this year alone. Meta is burning $5 billion a quarter on a metaverse with no horizon, while committing another $60 billion to AI capex. If these earnings show even a slight deceleration in cloud growth or a miss in AI revenue, $11 trillion of equity value will be forced to find a new home. In a world where the Fed is captured and the Strait of Hormuz is closed, that capital will not rotate into government bonds that yield 3.75% while inflation runs at 3% or higher. It will seek assets that have no counterparty risk, no burn rate, and no reliance on a functioning power grid. This is the great rotation that nobody sees coming. When the digital god of AI infrastructure is questioned, capital returns to the physical earth. We are moving from a world of bits, where value is found in algorithms and cloud growth, to a world of atoms, where value is found in the metal that makes those algorithms possible. The winners in this new landscape are the resource sovereigns. Nations like the UAE that have recognized the cartel era is over and are moving to secure bilateral dominance. The losers are the paper hegemons, institutions and investors who still believe that a 72.54 ticker price on a screen can override the reality of a global physical shortage. Can a nation print its way out of a fuel shortage? Can an algorithm replace a physical supply chain that has been severed at the strait? The answer is becoming clearer by the hour. The ripple effects of this week are not just market movements, they are the shifting of tectonic plates. The West is losing its grip on the coordination mechanisms of the 20th century, OPEC and the independent Fed, while the East is quietly cornering the physical foundations of the 21st. The West is losing its grip on the coordination mechanisms of the 20th century, OPEC and the independent Fed, while the East is quietly cornering the physical foundations of the 21st. As the $11 trillion tech cliff looms and the energy architecture fractures, the true value of silver is being revealed. It is the only bridge between the old world of energy and the new world of technology that cannot be burned, printed, or programmed into non-existence. We are standing at a structural inflection point, a rare moment in history where the inertia of the old world meets the friction of the new. As the clock ticks toward the close of this Wednesday session, the $72.54 you see on your screen remains a placeholder, a digital ghost of a price waiting for the physical story to catch up. But to truly understand the final verdict of this week, we have to look beyond the trading floor and into the blueprints being drawn in the halls of Geneva and the servers of Frankfurt. While the world's attention is fixed on the fracturing of OPEC and the $11 trillion earnings cliff in Silicon Valley, two other frameworks are being quietly ratified that will define the next decade of human organization. In Geneva, the World Health Organization is entering the final phase of negotiations on international pathogen protocols. In Frankfurt, the European Central Bank has just signed the standardization agreements to pave the way for the digital euro. These are not merely administrative updates. They represent the construction of a new, programmable architecture for the global economy. This is the post-digital fortress. The digital euro, targeted for a full rollout by 2029, is designed for a world of precision control. It is currency that can be timed, restricted, or expired, a tool for a world of managed scarcity and coordinated response. But there is a fundamental flaw in this architecture. You cannot program the laws of physics. You cannot update the conductivity of a metal, and you cannot patch a missing shipment of physical silver needed for a power grid. The contrast between the programmable future and the unprogrammable reality of silver is the core of the final verdict. Physical silver cannot be timed. It cannot be expired. It cannot be restricted by a central bank that has lost its independence to political whim. It simply is. And in an environment where the Fed chair is being replaced through a sequence that defies the traditional separation of powers, and where the German military is failing to procure fuel due to inflationary bottlenecks, the value of an unprogrammable asset becomes the ultimate strategic advantage. The $98 oil we are seeing today is the reality market's response to the narrative market's illusions. The White House can claim Iran is collapsing, but the physical supply calculation at the Strait of Hormuz, the reality of 17 days of restricted traffic, is what sets the price at the pump. Similarly, the paper-silver market can try to suppress the price through algorithms and headlines, but the 836 metric tons moving into China and the unresolved delivery pressure on the COMEX are the physical gravity that will eventually pull that paper price upward. We are moving from an era of institutional trust to an era of physical verification. For 50 years, we trusted that the Petro-Dollar would keep the energy flowing. We trusted that OPEC would keep the prices stable. We trusted that the Federal Reserve would keep the currency disciplined. This week, those trust-based systems are failing simultaneously. The UAE is walking away from the cartel. The Fed is becoming an arm of the executive branch. The AI infrastructure narrative, the last great hope for digital growth, is showing its first structural fractures with the cancellation of major data centers in Texas. The final verdict is this: the information lag is closing. The window of opportunity created by the divergence between the paper narrative and the physical reality is beginning to shut. When the $11 trillion of tech equity begins its rotation tonight, and when the market finally realizes that $98 oil is the new floor rather than a temporary spike, the rush into physical silver will not be driven by speculation. It will be driven by necessity. Silver is the irreplaceable bottleneck of the energy transition. It is the monetary refuge for a world where central bank independence is a memory. And it is the only asset that sits exactly at the intersection of the industrial future and the monetary past. We have spent decades believing that wealth is a number on a screen, protected by the institutions we built in the 20th century. But as we watch those institutions crack, we are reminded of a timeless truth. When the systems of men fail, the laws of nature reassert themselves. Scarcity is not a policy, it is a physical fact. Conductivity is not a narrative, it is an elemental property. Take a long look at the 7254 on your ticker. It represents the last gasps of a world that believes it can print its way out of a resource shortage. It is a number waiting for the story to catch up. And when it does, the resolution will not be a gentle adjustment. It will be a structural repricing of everything we thought we knew about value. The countdown is over. The transition has begun. Whether you're looking at the Strait of Hormuz, the COMEX vaults, or the Senate Banking Committee, the signal is the same. The era of the paper mirage is ending. The era of the physical fortress is here. Take care of yourselves. The world is about to get very real. I will see you in the next one.